Okay, hello everybody, and welcome to the VAT session today. What I'm going to do for you is cover some recent case law that might be of relevance to the charity sector, and then I'll also talk about current VAT issues that you might need to consider and might affect your organisation. In terms of specific areas, we'll be looking at 4 particular tribunal cases. I'll then cover some cases that have been outstanding for some time and are awaiting further hearings. And then for those of you who may have missed some of this, I'll give some updates on digital advertising, e-publications, and termination of contracts. And then finally, getting ready, areas that we need to think about preparing pretty quickly now, particularly with Brexit. So if we start off with the first case, Swanage Sea Rowing Club, and this considered the perennial question of whether or not a charity can issue a zero-rate certificate for the construction of a new building. What the club was looking to do was to zero-rate the construction of a building that it was going to be using to house some of its boats. It was seeking zero rating on the basis that it was either using the building as a village hall or it was using it solely for non-business purposes. Now, when the tribunal looked at the facts, it unsurprisingly found that the so-called boathouse didn't qualify as a village hall, but it then went on to consider whether or not the building was going to be used solely for a non-business purpose. And interestingly, the tribunal started off by looking at the Fisher tests, the 6 tests which are set out in Notice 7011. There has been previous case law which indicated that the Fisher tests weren't necessarily the definitive test, but nevertheless the tribunal looked at these to consider them in case they were helpful. However, in looking at those, it decided that these various tests, which really look at the predominant concern of the organisation and whether it's carrying out supplies on an ongoing basis in return for consideration, weren't really conclusive. So what the tribunal did was it went on to look at the test adopted in the Court of Appeal decision of Longridge on the Thames. And in Longridge on the Thames, this came up with the general rule that an activity will be an economic activity where it's permanent and carried on in return for remuneration, which is received by the person carrying out the activity. So what the tribunal considered was whether there was a direct link between the services that the club was supplying and the payments it was receiving. And in this instance, it found yes, it was clearly supplying services in return for consideration. Therefore, it was undertaking a business activity, and therefore the club wasn't entitled to issue a zero-rate certificate. Revenue during this process had obviously issued a penalty for the incorrect use of the certificate. So the next thing that the tribunal had to consider was whether or not the club had a reasonable excuse for issuing the certificate in the first place. Now, the club took no professional advice. It didn't go to a VAT advisor. It didn't seek any council opinion. It merely looked at Revenue's published guidance. And in particular, it looked at Notice 708 and concluded that zero rating should apply. It therefore decided to contact Revenue to seek some guidance, and it did so by telephone. It didn't write into Revenue, literally picked up the telephone and phoned Revenue. Obviously very lucky to get through in the first place, but nevertheless they managed to speak to someone at HMRC. The officer advised them that as long as there were no fees charged for the use of the boathouse itself, that zero rating could apply. So on that basis, the club went ahead and issued the zero rate certificate. Now, Revenue argued that in the absence of anything in writing from Revenue, a taxpayer can't rely on the advice given over the telephone. However, rather surprisingly, the tribunal accepted the evidence given by the witness and decided that there was a reasonable excuse and therefore no penalty should apply in this particular instance. I mean, this does beg the question of whether Revenue will appeal this decision, particularly as it seems to contrast with other cases, another one being Weststow Cricket Club, where the club in that instance did have a letter from revenue, but nevertheless was still subject to a penalty for issuing a zero rate certificate. So this is quite a surprising result, and I'm not sure how often we'll be able to point to telephone guidance from revenue as a means to rely on the advice that was given. I have to say that with regard to zero rate certificates, there does seem to be a growing trend of revenue attacking taxpayers who have issued a certificate. And really, we're caught in a bit of a difficult place. 9 times out of 10, if you seek to write to revenue and get a ruling, revenue will say no. You're then left with either taking professional advice or just ignoring revenue and issuing the certificate itself. But then, of course, you run the risk of penalties. And this does seem to be a growing trend of revenue. They seem to be challenging the issue of certificates more and more. If we now look at another case, University of Southampton Students' Union, this particular case revolved around whether or not the hot takeaway food and drink that was supplied by the Students' Union could be exempt. And they submitted a retrospective claim arguing that although they'd accounted for VAT in the past, these services should be exempt. And their argument for this was that the supply of the food and drink was closely related to the provision of education. And the provision of education, of course, is exempt when provided by an eligible body. The problem that the Students' Union had was that it didn't actually charge for most of the educational services it was providing, which meant that if it's not charging for its services, it's not actually making a supply. And so therefore, if it's not actually making a supply, it's impossible to argue that its services of food and drink is closely related, because if there isn't a supply, what is it closely related to? The only organisation that was actually making supplies of education was the university itself, not the Students' Union. During the course of the appeal, the Students' Union also sought to argue it was an eligible body. And if we consider what is an eligible body, as well as including a university or a college, also includes a charity that's providing education and uses the surpluses solely to the continuance or improvement of the educational activity. In the case of the Students' Union, there was nothing in its articles of association or in its practice that ring-fenced any surpluses to be used specifically for educational purposes. And hence, even where it did charge, and I think there was only one type of vocational training where it was making charges, even if it did charge, it wasn't actually ring-fencing any profits. And so therefore, again, the exemption didn't apply. Next, we look at Cheshire Centre for Independent Living. And what had to be considered here was the VAT liability of charges to disabled persons for running a payroll service for them. The disabled person employed their own carer, and what the charity did was it managed the remuneration of the carer. It was running the payroll as well as some other services for the disabled person. And the question was, what is the VAT liability of the payroll services? Now, the charity successfully argued in the tribunal that its services comprised of one of exempt welfare. And if we look at what exempt welfare covers, the VAT Act refers to services which are directly connected with the provision of care, and the Principal VAT Directive refers to supplies of services closely linked to welfare work. So the tribunal concluded that this seemed to cover, or appeared to cover, the services provided by the charity. Revenue appealed the decision to the upper tribunal on the basis that it said the first tier had made an error. As the carers were actually employees of the disabled person, they were not making any exempt supplies. Clearly, if you're an employee, the remuneration that you're receiving is outside the scope of VAT. You're not paying for any exempt services. On that basis, the payroll services could not be closely linked or be ancillary to any exempt service, and therefore, again, the exemption didn't apply. Revenue have issued a business brief 1620 covering this point, if anybody wants to go and have a more detailed look. There may be circumstances where the person who is providing the the services to the carer is actually making exempt supplies on the basis that they're not employed and that they're being paid specifically for that service. In that instance, it may be possible that this case will be helpful. And I do understand that there were several cases sat behind Cheshire Centre for Independent Living. Next, we look at a case called RSR Sports Ltd. Although RSR Sports Ltd is not itself a charity, some of the principles in this case may actually be helpful to some charitable organisations. And the key question in this particular case was whether the VAT treatment of school holiday clubs could be treated as exempt. And RSR argued that these were exempt on the basis that they constituted the provision of welfare. Now, when you look at the exemption applies to charities and state-regulated welfare bodies. And RSR was registered with Ofsted, therefore it was a state-regulated welfare body. Revenue disagreed. It said that actually the services are more activity-based rather than being one of welfare, and therefore the holiday camp services were standard rated. The tribunal obviously undertook a fact-finding exercise. It found that the holiday camps included both an activities element and also a childcare element. The activities element was emphasised by RSR in order to make the holiday camp attractive to potential customers. So although it referred to activities, it was doing this from a purely marketing perspective. The activities at the camp were supervised, but there was no coaching or teaching of relevant skills. And there was a much greater degree of staff qualification in the after-school clubs that were being run. And so it emphasised the difference between the two types of services, i.e. the after-school clubs and the holiday club. Now, the key features coming out of the case were that the members of staff were merely supervising activities. They didn't hold any coaching or teaching qualifications, and there was no external standard to which the services were being provided. The activities were merely an adjunct to the essential service, which was mainly one of childcare. On that basis, the tribunal found that yes, these services did constitute welfare services, and therefore the exemption applied. Now, Revenue have said they're going to amend their guidance to include that activity-based clubs can qualify for exemption as long as those key features are applicable in the circumstances they're looking at. And they've also again issued a brief, and that's brief 1820. The brief also says that if anyone has been applying VAT to these types of services, provided they meet those key features, they can go back retrospectively and make adjustments to the services they've provided and reclaim the VAT they've accounted for. So anyone affected might want to consider that particular brief. Okay, that was a quick run through of some recent cases. I now want to look at old cases that are still effectively outstanding because they're subject to further appeal. The first one there is the Wellcome Trust. Whilst we've had the Advocate General's opinion on this one, we're still waiting for the final decision of the European courts. And just to refresh your memory, the Wellcome Trust was a case that considered whether or not the reverse charge should apply on investment management fees that were used solely for non-business purposes. Wellcome sought to argue that as it wasn't undertaking a business activity, the reverse charge shouldn't apply. In the Advocate General's opinion, as Wellcome Trust is VAT registered, it's a taxable person, and therefore, regardless of whether these services are used for non-business activities, the reverse charge should still be applicable. The expectation is that the European Court will just confirm the Advocate General's opinion, but until we get that, that is still an open case. News Corp, this is still waiting to be heard in the Court of Appeal. And again, just to refresh your memories, the upper tribunal found that the e-publications or the e-newspapers that News Corp were providing did qualify for zero rating. And we're going to be looking at e-publications in a bit more detail later on. However, we're still waiting for that case to be heard in the Court of Appeal. Next, we have the Royal Opera House. Royal Opera House case is all about production costs and whether they have a direct and immediate link to bar and catering income. And if they do, the bar and catering income can then be included in the VAT recovery calculations. Royal Opera House succeeded with its appeal in the first tier tribunal. It lost in the upper tribunal, and I understand that the case will be heard by the Court of Appeal in March next year. That's an important one to look out for, because I think anybody who applies partial exemption or business, non-business methods will need to look out for the principles that hopefully this decision might clarify in terms of direct and immediate links. And then finally, a case that hasn't been heard yet, but one that we are running ourselves. With Buzzacott, we have a client who's been challenged by Revenue on what is meant by a license to occupy. And again, this could be an important case. In our particular circumstances, in our particular client, they are providing hostel accommodation, and Revenue are arguing that the residents who are staying in that hostel accommodation do not have a license to occupy. Case is scheduled to be heard in March next year. It'll be interesting for me because we're not actually going to the courtroom. We're going to try and do this one online. So that will be an interesting experience. But that will be one to look out for when we eventually get the decision. If it's heard in March, I expect the decision will probably come out a couple of months later. But that could be an interesting case in terms of what is meant by license to occupy. Okay, that's enough on tribunal cases. In terms of general updates, most of you should be aware of these, but just in case you've missed them, there has been the ongoing saga of digital advertising and whether or not these services can be zero rated. Ordinarily, charities can benefit from zero rating of advertising services, but there's been an ongoing debate about how that should be applied to digital advertising. The charity tax group has been making representation to Revenue on this, and Revenue have finally conceded and allowed zero rating, but only in respect to specific circumstances. And for anyone who's interested, you might want to look at HMRC Brief 1320, which sets out the specific circumstances when zero rating applies. The areas that Revenue have said don't qualify are targeted advertising. So in Revenue's opinion, digital advertising on social media and subscription websites is targeted at individuals, and in those circumstances, zero rating doesn't apply. So therefore, adverts to email addresses or social media subscription accounts won't qualify. What does this mean? Well, if you have overseas suppliers in the past who have provided you with digital advertising, the reverse charge will apply if those adverts are targeted. Now, again, Charity Tax Group is pursuing further representation on this issue and is looking for a test case to litigate, but again, one to keep an eye on. Following on from News Corp, although Revenue have appealed that case to the Court of Appeal, there has been a change, or there was a change of legislation with effect from 1st of May 2020. Revenue now accepts that e-publications can qualify for zero rating, and I've listed there some of the areas that will qualify. Again, this is an important change in law. If you have subscription income, for example, in the past, any e-publications would have been treated as standard rated. It may be possible to carve out that part of the subscription and argue it could be zero rated. So this is good news for organisations running membership subscriptions. Similarly, there could be reduced cost for charities. In terms of News Corp and the application of this, in terms of retrospective claims, it is possible to submit a claim on the basis, or for suppliers to submit claims on the basis that News Corp applied and therefore e-publication should have been zero rated before the 1st of May. That will be determined by the Court of Appeal. If you've been applying the reverse charge to overseas purchases, again, there may be instances where you can submit a retrospective claim to Revenue. Early termination of contracts. I've included this in here because during this COVID crisis, where charities and other organisations are not necessarily operating, some organisations may be looking to terminate contracts early. for example, cleaning contracts, security contracts. You may be looking to get out of those kind of contracts because you no longer need those services. Revenue have made a bit of a mess of this one. The position in the past was that if there was an existing contract in place and the contract for those services included a termination clause, if the contract was terminated early, any payment for that early termination was outside the scope of VAT. However, if the contract was silent and therefore needed separate agreement, Revenue's guidance was always that in those circumstances, VAT would be applicable. Completely out of the blue, Revenue decided to change their policy following 2 European court judgments, which actually involved the supply of mobile phone networks and telephones. Revenue issued a business brief 12/20 saying that all early terminations were now subject to VAT. Even more surprisingly, they wanted to apply this retrospectively. So although their guidance set out what the position was and had been prior to them changing their policy, they were seeking to go back retrospectively 4 years. Now that does beg the question of whether a taxpayer had a legitimate expectation to rely on Revenue's guidance. However, following more representations from the profession, Revenue have said that they're not going to take any further action on this until they've considered this issue in more detail. The problem with this approach, of course, is that Revenue have not withdrawn the business brief they issued. It's still out there in the public domain. And similarly, they've not updated their amended VAT manuals. So anybody who's not aware that Revenue won't be necessarily applying their change of policy at the moment and just goes in to look at Revenue's guidance will be completely misled. Very unsatisfactory position, but nevertheless one that you should be aware of, given that, as I say, more and more organisations looking to terminate contracts early. Earlier this year, we had the temporary reduced rate introduced, and the reduced rate of 5% applies to admissions to attractions, holiday accommodation, sale of food, and non-alcoholic drinks. Initially, this was applied between the 15th of July to the 12th of January 2021. That's now been extended to the 31st of March 2021. However, I haven't actually seen any published guidance confirming that extension. And I've actually come across 3 circumstances now where I've been speaking to officers from Revenue, and they've actually asked me to produce evidence that the cut-off point for the reduced rate is the 31st of March and not the 12th of January. And the only thing I've been able to send them is articles on BBC websites referring to Rishi's announcement. So it's just something to be aware of. When you're speaking to Revenue, they may not necessarily have realised, or some officers may not have realised, that this period has actually been extended. In terms of a planning point, if you receive payments for any services that you may be providing after the 31st of March, if you receive payments before that date for events taking place after 31st of March 2021, because the receipt of payment crystallises a tax point, the 5% could still apply. Okay, so there may be an opportunity there to maximise the use of that relief. Extension of the VAT deferral payment scheme. Again, during the early COVID period, the Chancellor announced that taxpayers can defer making payments of the VAT due on their VAT returns between the 20th of March to 30th of June. The cut-off point of making those payments was the 31st of March 2021. There is now provision there to extend that further to the end of March 2022. Okay, so a taxpayer can actually make smaller payments up until 31st of March 2022. You have to opt into the scheme. It's not an automatic scheme, and it requires a direct debit to be set up as part of the digital opt-in process. And my understanding is that the way this will work is that you'll make 11 payments spread out over a course of the 12-month period, roughly about 9% of the total value that's due to Revenue. Okay, that's all I wanted to cover on updates. And now the horrible news, really, I suppose, in terms of are we getting ready? There are a couple of areas that taxpayers need to get themselves ready for change. And the first of those is making tax digital. Many organisations are using bridging software to file their VAT returns, and they're able to do so during the soft landing period. But we have to remember this soft landing period finishes on the 31st of March 2021. For any VAT returns starting after the 1st of April next year, the accounting records must have digital links throughout the chain. Okay, and a digital link is an electronic or digital transfer or exchange of data between software programs or applications. Okay, the use of cut and paste doesn't constitute a digital link, so you won't be able to use that. You can carry on using it during the soft landing period, but come 1st of April next year, you need to make sure you have digital links in place. Okay, and I've listed there other areas where Revenue accept digital links are acceptable. Emailing a spreadsheet, surprisingly enough, containing digital records is deemed to be a digital link. Now, there are some calculations that can continue to be made outside of the digital software. For example, your VAT recovery calculations, capital goods scheme calculations, you can still calculate those manually as long as the information is input into the accounting system. I put a question mark next to reverse charges, and this really is because, again, technically you will need digital links to pick up your reverse charge invoices. The practical issue is that most organisations that I advise tend to do this manually, in that there's nothing there that automatically picks out reverse charge invoices. So what you may want to have to do there is somehow use your accounting software to tag particular suppliers so that it automatically picks up the reverse charge for you. Now, if you're not going to be ready by 1st of April next year, when the soft landing period finishes, you can apply for an extension. However, there are strict rules regarding the reasons for an extension, and again, details are found in Notice 722. I have to say, making tax digital, not really a VAT technical point, but really one for your accounting software providers to have conversations with. And then finally, Brexit. This seems to have fallen under the radar for many people, but has slowly and finally crept up on us. Everyone's focus has been on COVID, but we don't have that long to go now until the transitional period finally finishes on the 31st of December. So what I've tried to do here is give you a very short checklist of some areas you might want to be considering. If you're moving goods into or out of the UK, do you have an EORI number, an electronic operator registration number? You're going to need that in order to be able to move your goods. Have you given consideration to who's going to make out your customs declarations? Now, whereas at the moment you might be acquiring goods from EU countries, from 1st of January next year, those will now be imports. You're going to need a customs declaration. Have you given thought to who will do that for you? From 1st of January 2021, businesses will be able to use postponed VAT accounting to account for the import VAT on their VAT returns and claim it back in the same return. So hopefully the position would be neutral. However, again, you may need to tweak your VAT accounting package to make sure these things are picked up. As you're now going to be importing goods from Europe rather than acquiring goods, potentially there's going to be the added cost of customs duty. Have you taken steps to find out what that cost will likely be, as this will be an added cost? And let's not forget, unlike VAT, customs duty can never be recovered. It's an added cost. When you're importing goods and have to make out an import entry, you need something called a trade classification number. You may need import-export licenses. These are all areas where hopefully your freight forwarder can help you, but have you taken steps to make sure you're ready? If you're dealing or trading with Northern Ireland, there will be special rules for Northern Ireland, and this is an area where really it's only in the last few weeks we've started getting more and more information as to how Northern Ireland should be treated come the 1st of January, but they will have, anyone registered for VAT in Northern Ireland will have a special VAT number. I think it will be prefixed with an XI. If you're trading with Northern Ireland, recommendation to sign up for the Trader Support Service. This will give you additional information specific to those type of transactions. If you're moving goods into EU countries, you'll need to check what the special rules are for each particular EU member state and whether you need a fiscal rep in that country. Each country will have different rules, but again, you need to take steps to check what the rules are in particular. If you incur VAT in other EU countries from 1st of January 2021, you'll have to submit paper claims to recover the VAT in that country, and that goes via the 13th Directive refund process. If you're supplying digital services to consumers, pre-recorded broadcasts, for example, the place of supply is where your customer belongs, and at the moment you can use the mini one-stop shop process to account for VAT. From 1st of January next year, you won't be able to do that. You'll have to register in one particular member state. Most organisations seem to be going for Ireland on the basis that Ireland, the language is English. Once you're registered in an EU member state, you can use the non-EU MOS to submit your VAT account for VAT. If you don't do that, you'll have to register in each country where you're making supply. So you could end up with registrations right across Europe. Okay, that's a quick run through case law, general updates, and what we need to think about getting ready. If you have any questions, please feel free to ask. Many thanks.